Are you tired of losing money in crypto and Forex? I know exactly how that feels. Every successful investor has first experienced the pain of losing. Have you lost money in your trades and now find yourself unable to sleep at night? Are you exhausted from stress, anxiety, and uncertainty? You are not alone, but putting an end to this is entirely in your hands. Every loss wears down your psychology and affects your life. Sleepless nights and anxious mornings don't lead to success, they lead to even bigger mistakes. But you can change this. By learning to invest consciously and manage your risks, you can take back control of your life. With a healthy trading mindset, peaceful nights are possible. Remember, a good investor is one who protects not just their capital, but also their mental well-being. If you want to learn chart patterns, trend breaks, and all other concepts in technical analysis, you must first learn risk analysis. Without risk management, even the best formations, flawless trend lines, and technical indicators are meaningless. Because in the markets, knowing how not to lose is just as important as knowing how to win. If you cannot manage your risk, even the most promising-looking analyses can lead you to losses. Long-term success in technical analysis is only possible when you learn how to control your risks. Manage your risk first, then aim for profit. Let's set aside technical analysis and candlesticks for now. First, learn risk analysis. Most investors focus solely on profits in the market. Which coin will rise? Which pattern is working? Where should I buy? However, true professionals focus on not losing, because the key to staying in the market is not chasing big profits but protecting your capital to achieve long-term gains. So, what is risk analysis and why is it important? Risk analysis is the process of determining how much money you are willing to risk in a trade, at what level you will stop your losses, and the ratio of potential profit to potential loss. There is no profit without risk, but uncontrolled risk always leads to losses. Fundamental principles of risk management. Determining the risk-reward ratio. How much can I lose, and how much can I gain in a trade? If your potential loss is greater than your potential profit, that trade could lead to long-term losses. Recommended minimum risk-reward ratio, 2:1. In other words, for every $1 you risk, you should have the potential to earn at least $2. Capital management. Each trade should be planned so that only 1% to 3% of your total capital is at risk. This is the fundamental rule to avoid significant losses. Using stop-loss orders. Successful traders never trade without a stop-loss. Accepting a loss is not a weakness. It is a necessary step to protect your capital. You can see our risk-reward ratio from the section I have marked. This ratio must be at least 2:1. In other words, your move should be aimed at earning twice the amount you are willing to lose. Even if you win only 50% of your trades, you will still remain profitable. Example: 2 + 2 = 4 are profit. 1 + 1 = 2 are loss. Total: 4 to 2 = 2 are profit. A conscious investor determines their target in advance, knows where to exit, take profit (TP), knows where to cut losses, stop loss (SL). This strategy minimizes emotional decisions and ensures a more stable investment process. What is stop loss? Stop loss, also known as a stop-loss order, is a risk management tool that allows investors to automatically close their trades at a predetermined price level to prevent further losses. In summary, if the price reaches your predefined stop-loss level, the system will automatically close your trade, preventing you from incurring greater losses. You need to enter your stop-loss price order in the area I have indicated. What is the take-profit zone? The take-profit zone is the price level at which investors automatically close their trades to secure their profits. This level is also known as the take-profit (TP) point. In summary, when you open a trade, you can set a take-profit (TP) order to automatically sell your asset once it reaches your desired profit level. This ensures that you secure your gains even if the market suddenly reverses. You can enter your take-profit price order in the area I have shown within the circle.
Which is more important, technical analysis or risk analysis? If you don't understand risk management, even the best technical analysis won't make you profitable. However, if you master risk analysis, you can make small mistakes in technical analysis without suffering major losses. Priority order. Learn risk management first. Then focus on chart patterns, trend breaks, and candlestick analysis in technical analysis. To be a smart investor, you must first learn how to stop losing. Profits will naturally follow as long as you manage your risks properly. Today, we explored the risk-reward ratio in detail. Now, we understand that successful trading isn't just about focusing on profits, but also about managing risk effectively to ensure long-term success. If you want to develop your skills in risk management and technical analysis, stay tuned for my upcoming videos, where I will cover harmonic patterns, smart money concepts, and price action in detail. Share your thoughts in the comments. Feel free to share your thoughts, questions, and expectations about the video in the comments. Your feedback is extremely valuable to me. If you let me know what topics you're curious about, what areas you'd like to see more details on, or what kind of content you'd like to see in the future, I can shape my next videos to fit your needs. Ask your questions, and I will create new content to answer them. Let's meet in the comments. Don't forget to subscribe to the channel and like the video to support me. See you in the next video, wishing you profitable trades.